select small savings schemes. Rates on most schemes like term deposits that range from 1 year to 5 years have been cut by 0.2 percentage points. The Public Provident Fund Scheme, Kisan Vikas Patra, have also seen a rate cut. But rates on the 5-year senior citizen scheme has been left unchanged by the government. This is consistent with what the government had announced over a year ago, that the rate of all small savings schemes have been calibrated since April 2016. And for more on that, to discuss the macro numbers, the government decision to cut their interest on the small savings schemes, I'm delighted now to be joined by Niti Aayog Vice Chairman, Mr. Rajiv Kumar. Good evening, sir. Thank you, and always a pleasure to speak with you. If I could just, before we go to the fiscal deficit numbers, sir, that have come in today on the borrowing front, if I could get your quick reaction, sir, on the government decision to cut the interest on the small savings scheme, because one is a bit perplexed by this move by the government, especially at a time when bond yields are hardening, and perhaps it may the hardening may intensify after the borrowing numbers the government has announced today, and also with inflation inching up. Is there a larger message, perhaps, that the government is trying to send out through this move?
Good evening, Ranajay. Let me first clarify that the assumption that bond yields could further harden, I don't think would be true, because by today's announcement, the government is also making clear that they're making clear that there is not going to be sort of net borrowing in the sense that in this quarter. The additional borrowing has been announced in advance, but then there will be, the government would be returning, repaying some of the debt to the RBI, etc. So I'm not sure that there will be a further, tightening of the bond yield. And I think the decision to cut the interest rates is actually in the same direction. The government trying to signal that they expect the interest rates, they expect the cost of capital to come down in the coming days, and hopefully nudge the yields downward as well through that action.
All right, interesting, sir. But let's get you to comment perhaps also the bigger the macro picture, because one is wondering, are we moving from a benign macroeconomic environment that we may have had in the last 2 years to a more challenging environment? Crude prices are going up, inflation is inching up. As a preeminent economist to the government of India, how do you see these headwinds?
Yeah, so on the oil front, I think the news that I got yesterday and today is that they seem to have peaked and they may not rise further, because some new oil supplies are now coming onto the market. That's what I heard. So that I think may not, that will not hurt us very much more. And the current account deficit, I think, will stabilize around the level that we have at the moment. On the on the inflation rate, I think it is likely to inch up further to maybe about 5.5 just now, a sort of seasonal thing. But we'll probably see the year end at about 5%, which is well within the RBI range of 4 plus minus 2. So it's not something that you could. It's not something to be sort of really too concerned about, because 5% inflation is well within the RBI range, and not high at all in any way. On other macro numbers, the fiscal deficit, of course, the government has clearly indicated that there is additional borrowing here, and so maybe that number would slip, but just by a small margin. And that will also be well within the NK Singh Committee's recommendation, which is, that if you had some major structural reforms, the slippage of 0.5% is quite permissible. So I'm not sure that the macro picture is cause of any worry. The macro balances are there. The current account, the fiscal account, the growth, the inflation. I think all of those are well within control, and you will see therefore that leading up to the budget, a rather benign macroeconomic situation, as you go towards the budget.
All right. You know, talking about the additional 50,000 crore borrowing that the government has announced today, let's talk about what its implications could be on the fiscal deficit target, sir, because I remember you in one of an interviews to CNBC TV18, you said that heavens will not fall if the fiscal deficit target of 3.2% were to get breached and if it reaches 3.5%. But what happens if it does hit 3.5% or perhaps inches slightly higher? What happens? I mean, do you see the ratings agencies may frown upon this somewhat?
I don't. Well, rating agencies have continued to frown even when we had consolidated the fiscal deficit in the last 3 years, and then and met all the targets, etc. It's only one of them after 13 years which has sort of smiled at us. So whether the credit rating agencies will frown or not is something which is quite unpredictable because their behavior doesn't seem to be driven by any sort of macroeconomic drivers, etc. My own understanding, as I said, and I stand by that heavens will truly not fall if the fiscal deficit targets are reached, because the amount of work that's been done and the reforms that have been put in place and formalization of the economy, plus the improvement, the bringing in of the GST, I think have laid the basis for much higher rates of growth in coming time, and the credit rating agencies will look at that as well. And as I think S&P said, if the prospects are good, then the credit rating agencies are unlikely to frown upon or take any precipitate action.
All right, Mr. Rajiv Kumar, always a pleasure. Thank you very much, sir, for joining us this evening with your quick take on some of the big macroeconomic numbers that have come in today. So heavens will not fall even if the fiscal deficit